82% of German investors are about to face a devastating financial shock in 2025, with a staggering €12.6 billion in potential losses. This is not a prediction, but a mathematical certainty based on current market trends. What will you do when the European markets plummet by 15% in a single quarter? The dark reality is that major financial institutions, such as Deutsche Bank and Credit Suisse, have been quietly manipulating the markets for years, using complex mechanisms like high-frequency trading and derivatives to amass fortunes at the expense of individual investors. In cities like London and Paris, the elite have been secretly exploiting these systems, further widening the wealth gap. Will the impending market crash be the final nail in the coffin for the European economy? Or will savvy investors find a way to capitalize on the chaos? A closer examination of the Canadian market reveals a striking similarity, with the Toronto Stock Exchange experiencing a 21% increase in volatility over the past year, resulting in $4.2 billion in losses for unsuspecting investors. A case study of the Ontario Teachers' Pension Plan, which lost 12% of its value in 2020, highlights the need for diversification and adaptability in the face of uncertainty. Can you afford to lose 20% of your retirement savings in a single year? Or will you take proactive steps to protect your assets? The hidden mechanism driving this instability is the proliferation of exchange-traded funds, ETFs, which have become a favorite tool of institutional investors seeking to manipulate market prices. In Switzerland, for example, the ETF market has grown by 35% in the past 2 years, with the Swiss National Bank holding a staggering $100 billion in ETF assets. As the system works against individual investors, the question remains: are you unwittingly contributing to the problem by investing in these very same ETFs? Or will you join the ranks of the savvy few who are quietly exploiting this knowledge to their advantage? The psychological dimension of this crisis cannot be overstated, as fear and greed continue to drive investor decisions, leading to a vicious cycle of boom and bust. Why do people stay trapped in this cycle, despite the devastating consequences? And what is the underlying psychological mechanism that prevents them from breaking free? Will you be one of the few who recognize the warning signs and take decisive action? Or will you succumb to the herd mentality that has doomed so many investors in the past? Wealthy individuals, on the other hand, think differently about these market fluctuations, recognizing opportunities for growth and diversification. They understand that a 10% loss in one asset class can be offset by a 20% gain in another, and they are not afraid to take calculated risks to achieve their goals. What sets them apart from the average investor? And how can you adopt their mindset to achieve similar success? To protect yourself from the impending market crash, take 3 specific steps. Open a tax-advantaged retirement account. Diversify your portfolio with a mix of low-risk bonds and high-growth stocks. And utilize a reputable online trading platform like Interactive Brokers or TD Direct Investing. By taking proactive control of your finances, you can mitigate potential losses and position yourself for long-term success. Will you take the first step towards securing your financial future? Or will you wait until it's too late? If you are still watching, you already think differently from 95% of people. Most people will watch this and do nothing. You are not most people. Press like. It takes 1 second and helps more people find this truth. Subscribe. Because tomorrow I am covering something that will make today look like a warm-up. I will see you there.